Before we talk about investing today, we need to settle something far more controversial than stocks versus bonds: hard shell or soft shell, ground beef, steak, chicken, carnitas, or shrimp, salsa roja or salsa verde. And I'm going to take it just a bit further: gringo taco or authentic Mexican street taco. And don't even get me started on tacos versus burritos, because apparently everybody has an opinion on what belongs on the plate. And you know what? Wall Street isn't much different. Stocks, bonds, cash, ETFs, mutual funds, options, alternatives, everybody seems to have a favorite ingredient. But today, we're not asking which ingredient is the best. We're asking a much more important question: how do the ingredients work together? Because we've spent the last several Taco Tuesdays learning about the menu, but today we build the plate. So let's go. What's going on, everybody? Happy Taco Tuesday. Welcome back to the Unbearably Bullish podcast, the official podcast of the Bull You Can't Bear. And I'm your host, Donald Johns. And if you've been following our Taco Tuesday series, we've been building our financial menu piece by piece. We've talked about options. We put ETFs on the menu. We've broken down mutual funds. We've talked bonds. And last week, we opened up the secret menu and explored alternative investments and private securities. Today, we're bringing the ingredients all together. We're talking asset allocation, diversification, risk, correlation, portfolio overlap, rebalancing, and why owning a bunch of different investments doesn't necessarily mean you have a diversified portfolio. And we're doing all of it Taco Tuesday style, baby. So grab a plate, grab some salsa, maybe grab a napkin, because this could get a bit messy, and let's build the plate. Let's start a fight right away. On one side, we've got the classic Americanized taco: hard shell, seasoned ground beef, shredded lettuce, cheese, tomato, sour cream, maybe enough toppings that you can barely find the taco underneath. And on the other side, you've got the traditional Mexican street style taco: soft corn tortilla, seasoned meat, onion, cilantro, lime, salsa, different construction, different ingredients, different experience. Now, I'm not getting between anybody and their taco traditions, okay? That's dangerous territory, but here's the investing lesson: different plate doesn't automatically mean wrong plate. Two investors could have very different portfolios, and both portfolios could potentially make sense within their respective circumstances. Why? Because investors can have different goals, time horizons, income needs, liquidity requirements, risk tolerance, risk capacity, tax considerations, financial circumstances. One person's portfolio doesn't automatically become the blueprint for somebody else's. And that's why financial education has to go deeper than what should I buy. A better starting question is, what am I trying to accomplish? Because before we choose the ingredients, we need to understand who's eating. Now let's settle another one: taco or burrito. A taco puts a lot of the ingredients right in front of you. A burrito, everything gets wrapped together: rice, beans, protein, cheese, salsa, maybe guacamole, maybe sour cream. And once it's wrapped, you see one burrito, but there could be a whole lot happening inside. Investments can work similarly. You can look at the investment statement and see one ETF or one mutual fund, but that single position can potentially represent exposure to dozens, hundreds, or even thousands of underlying securities. So here's today's burrito lesson: you bought one burrito, that doesn't mean there's only one ingredient inside. That's why understanding underlying holdings matters. What's actually inside the fund? What sectors? What companies? What countries? What types of bonds? What risk exposures? What's the concentration? Because the wrapper tells you what you ordered, the ingredients tell you what you're actually eating. Hard shell, soft shell. I already know somebody watching is yelling at the screen right now, but here's the lesson: different structures behave differently. And that's true with investments too. An individual stock isn't structured like a bond. A bond isn't structured like an ETF. An ETF isn't identical to a traditional mutual fund. An option is completely different type of instrument. A private investment may introduce liquidity limitations, valuation considerations, longer holding periods, or other complexities that don't necessarily exist in the same way in a publicly traded security. So don't just look at the name on the menu, understand the structure underneath it. How does it work? What do you actually own? How liquid is it? What are the fees or expenses? What are the risks? How might it behave under different conditions? The shell matters. Now we're getting serious. What's going on inside? Ground beef, steak, chicken, carnitas, shrimp. Maybe you're screaming, Donald, al pastor. Fair enough. Put it on the board. But here's where we get to one of the most important principles in today's episode. Every ingredient needs a job. Think about a portfolio. Stocks may be used for growth-oriented exposure, but they also involve market risk and can experience substantial volatility. Bonds may be used for income, diversification, or other portfolio objectives, but bonds have their own risks too, including interest, rate risk, and credit risk. Cash and cash equivalents can provide liquidity and stability, but they also have purchasing power and opportunity cost considerations. Alternative investments may provide exposure to different return drivers, but they can involve additional complexity, fees, liquidity restrictions, and risks. Options can potentially be used for several purposes, but they involve significant risk and aren't suitable for every investor or strategy. The point isn't steak is better than shrimp. The point is, what job is that ingredient supposed to do? Growth, income, liquidity, diversification, capital preservation, risk management, inflation sensitivity, something else? Before asking what's hot, ask what's the job? How much heat can you actually handle? Now, salsa roja or salsa verde. Some people want mild, some people want medium, and then there's always that one person who sees extreme heat and says, yeah, give me extra. 5 minutes later, they're sweating, eyes watering, looking for milk, questioning every decision they made since childhood, and everybody at the table is saying, you said you could handle it. Well, markets have their own version of hot sauce. It's called risk. It's easy to say I'm comfortable with volatility when everything is going up. It's different when the portfolio is actually experiencing losses. That's why it's useful to distinguish between two concepts: risk tolerance, your psychological willingness to experience uncertainty and market fluctuations, and risk capacity, your financial ability to withstand losses or volatility given your circumstances and objectives. They're related, but they're not necessarily the same. So before loading your financial taco with the hottest salsa in the restaurant, understand what kind of heat you're actually dealing with. This is the one that's going to get somebody in trouble. Imagine I build a taco: cheddar, Monterey Jack, queso, pepper jack, Mexican blend, more shredded cheese, please. And I hold it up and say, look how diversified my taco is. No, Donald. That's 6 versions of cheese, and portfolios can have the same problem. Imagine somebody owns a technology-orientated ETF, a large cap growth ETF, an innovation fund, a NASDAQ-orientated fund, another growth mutual fund, 5 different ticker symbols, 5 different investment names. But when you look underneath, there could potentially be significant overlap among the companies, sectors, or risk factors those investments hold. That's why number of holdings does not automatically equal diversification. Diversification can involve considering exposure across different asset classes, industries, sectors, geographies, investment styles, maturities, issuers, and risk factors. And even diversification does not eliminate the risk of investment losses, but the larger lesson is simple. 5 labels don't necessarily mean 5 different ingredients. Check the cheese. When everything gets hot at once, now we're leveling up the financial education. So let's talk about correlation. Correlation helps describe how two investments have historically moved in relation to each other. At the extremes, a correlation near +1 indicates a strong tendency to move in the same direction. Near zero suggests little consistent linear relationship, and near -1 indicates a strong tendency to move in opposite directions. Why does that matter? Because portfolio construction isn't necessarily about evaluating every investment in isolation. It's also about understanding how the ingredients may interact. But here's the warning: correlations aren't guaranteed to remain constant. Relationships between assets can change over time and may behave differently during periods of market stress. So, diversification isn't, I bought a bunch of stuff, it's understanding the exposures and how they may relate to one another. When diversification becomes complexity, okay, let's build the biggest taco in history. Stocks, throw them in. Bonds, get in there. 3 ETFs, absolutely. 7 mutual funds, pile them on. Private investments, give me more. Options, Donald, the shell is starting to crack. More cheese, more salsa, more guacamole. The taco is collapsing. Stop. Here's the point: more investments do not automatically create a better portfolio. Sometimes additional holdings can introduce overlap, complexity, additional costs, unintended concentrations, difficulty monitoring the portfolio, or investments without a clearly defined purpose. There's even a tongue-in-cheek term sometimes used in finance called diversification. Adding investments simply for the sake of adding them can potentially make a portfolio harder to understand without necessarily improving it. So here's today's rule: if you can't tell what's inside the taco anymore, maybe you added way too much. Let's fix the plate. Imagine you build the perfect taco, everything distributed nicely. Then somehow all the steak slides to one side. The salsa is on the other. Guacamole is falling out the back. You take one bite and the entire thing explodes onto your shirt. That's a Tuesday tragedy. Portfolios, they can drift too. Suppose an investor begins with an intended asset allocation. Over time, different investments may rise or fall at different rates. That can change the portfolio's weightings. Rebalancing generally refers to evaluating those allocations and potentially bringing them closer to the intended targets. That doesn't mean rebalancing is automatically appropriate at the particular time or in a particular way. Taxes can matter. Transaction costs can matter. Account type can matter. Market conditions and individual circumstances can matter. But educationally, here's the concept: the plate you built can change as the ingredients move. So portfolio construction isn't necessarily a one-time event. It may require ongoing evaluation. Now let's do tacos versus burritos. We've talked enough finance. I need the herd to settle this right now. You can only choose one for the rest of your life. What is it? Tacos or burritos? And don't write a 700-word essay defending your decision. Actually, you know what? This audience probably will. I'm staying out of it. Moving on. Let's build the plate. Now let's bring everything together. Instead of starting with what's the hottest investment, try starting with questions. What is it? What does it own? How does it work? What role is it intended to serve? What risks does it introduce? How liquid is it? What does it cost? What might it overlap with? How might it interact with the rest of the portfolio? And why is it on the plate? The last question matters, because if you can't explain why an investment is there, that's worth investigating. What's the objective? All right, we've survived gringo tacos versus authentic Mexican, hard shell versus soft shell, beef versus steak versus chicken versus carnitas versus shrimp, salsa roja versus salsa verde, tacos versus burritos. But we've reached the most important decision of the entire episode, and you only get one: dessert. Churros, ooh, they're so good. Warm, crispy, cinnamon sugar, maybe some chocolate dipping sauce, or tres leches, soft, rich, creamy, completely different experience. Which one? And don't say both. We're building a portfolio here. But dessert actually brings us to the final investing lesson. Before building any portfolio, you need to understand the objective. Why are you investing? Retirement, income, long-term growth, education funding, liquidity, legacy planning, a future purchase, other financial goals, because you can spend an enormous amounts of time debating the ingredients and forget why you came to the restaurant. And that brings us to one of today's most important questions. When somebody asks, what's the best investment? My educational response would be best for what? Because best without context doesn't tell us very much. Different investors can have different objectives, constraints, and circumstances, just like churros aren't automatically better than tres leches, although I'm sure somebody is already furious that I just said that. Let's do the Bulls bottom line. Today, we built one heck of a plate. We got tacos, burritos, hard shells, soft shells, beef, steak, chicken, carnitas, and shrimp, salsa roja, salsa verde, 6 kinds of cheese, an exploding taco, churros, and tres leches, and somehow we learned portfolio construction. But underneath all the fun is a serious lesson. Every ingredient needs a job. Know what you own, know what's inside it, understand the structure, understand the risks, understand the costs, understand the potential overlap, understand how the pieces may interact, and most importantly, know why it's on your plate. Your portfolio doesn't need to look exactly like somebody else's, because different plate doesn't automatically mean wrong plate. The objective isn't to build the world's perfect taco, and it's certainly not to copy the plate sitting at the table next to you. The objective is to understand the principles behind portfolio construction and evaluate investments within the context of your own objectives and circumstances. So build the plate, understand the ingredients, know their job, and for the record, I'm still not settling tacos versus burritos. I'll let the herd fight that one out. But churros versus tres leches, you know what? Forget the rules. I'm ordering both. I'm Donald Johns. This is Taco Tuesday on the Unbearably Bullish podcast. The bull you can't bear, strong markets, stronger mindset, unlimited opportunity. Let's always connect, collaborate, and monetize. Please follow the herd and like all of our pages, and always stay unbearably bullish. Have a wonderful day. We love all of you. I'm going to do the educational disclosure. The opinions expressed in this podcast are those of the host and are provided for general, educational, and informational purposes only. Nothing discussed should be construed as individualized financial, investment, legal, or tax advice, or as a recommendation, solicitation, or endorsement to buy, sell, or hold any security, investment product, strategy, or asset class. Investing involves risk, including the possible loss of principal. Diversification and asset allocation do not ensure a profit or protect against a loss. Investment products and strategies involve different risks, costs, tax consequences, liquidity characteristics, and suitability considerations. Past performance does not guarantee future results. Options involve risks and are not suitable for all investors. Investors should review the applicable option disclosures materials, including the characteristics and risks of standardized options, before engaging in options transactions. Alternative and private investments may involve additional risks, including illiquidity, limited transparency, valuation uncertainty, higher fees, and restrictions on transfer or eligibility. Individual circumstances vary. Conduct appropriate due diligence and consult qualified financial, legal, and tax professionals regarding your individual circumstances before making any investment decisions. Have a wonderful day.